Hello friends, how are you all? My name is Harshit Dwivedi friends and I welcome you back to my video. So in this video friends, I am going to talk to you about call money market, notice money market and term money market. So what are these things friends? Term money, notice money and call money. So before starting with this thing friends, I would like to tell you that first of all, go and watch the video in which I have told the difference between the money market and the capital market. Money market and capital markets are two types of financial markets, and the whole, you can say, detailed analysis of the difference between money market and the capital market has been explained. And basically this call money, notice money and term money is basically they are instruments of money market. Money market works for short duration. Now, in some places, in one line, it is written that loans which are taken for short duration. This short duration varies from 1 to 14 days in some case or 1 to 15 days in some case. If the money is taken for 1 day, it is termed as call money. If the money is taken from 2 to 14 days or 2 to 15 days, then it is termed as notice money. Okay, and term money is that money which is being lent for more than 14 days or more than 15 days. So this classification of call money, notice money and term money. Call money is for 1 day in India, notice money is for 1 to 14 days or 1 to 15 days. Sub classification is there. Some people say 1 to 14, some people say 1 to 15. It depends upon contract to contract. And term money is that money which is taken for more than 14 or 15 days. Okay, so this is basically call money, notice money and term money. But the basic premise of this thing is not known by many people. What is the basic premise? What is this short-term loan which is being taken here? This is why we need to understand the interbank rate. If we will be able to understand the interbank rate, we will be able to understand this money market which is working here. Interbank rate. This is what we need to understand. Now basically here, what is being happening that most banks are parking their day-to-day surplus funds to get some extra interest on it. I will come on to it. Just be a bit patient. Interbank rate. When we talk about interbank rate, before seeing this friends, I will suggest you that go and watch my video on federal fund rate. I have made a video on federal fund rate. This federal fund rate operates in the US. The basic premise of operating I have explained in that video. Kindly go and watch that video and come back to this video. Or even if you are not watching it, then also this thing will be clear to you. See what is happening. An interbank call money market, and forget this call here. An interbank money market is a short-term money market which allows for large financial institutions. Kindly notice, there's large financial institutions includes bank. They also includes mutual funds. They also includes corporations. They borrow and lend money at interbank rate. And that interbank rate, there is a target in US which is known as federal fund rate. So basically federal fund rate is being fixed by the Federal Reserve in a range, and obviously the policies are done in such a manner that that range can be fulfilled. Okay, so basically the money market, especially the call and notice money market, the loans in this money market are very short. Okay, and they, in most of the cases, they don't last longer than 1 week, and they are there to meet the reserve requirements of bank. I will come to that friends, kindly be patient. And one more important factor, it is not exclusively used by banks. It can also be used by bank, mutual funds, large corporation, insurance company. Now you need to understand friends. In the context of India, I'm going to explain you, the things will be clear to you. In the context of US, I've already explained in the federal fund rate video, so you can watch that video if you're watching from the US. Now see friends, what is happening here? RBI places a lot of restrictions on the scheduled commercial banks in India. Those restrictions are in the form of cash reserve ratio, statutory liquidity ratio, and many more restrictions are there. So in order to meet these reserve requirements, some amount of money has to be kept in CRR, some amount of money has to be invested in SLR. Now, in order to complete these reserve requirements, overnight market borrowing is being done by these banks. Overnight borrowing is being done by these banks. Okay, so basically, banks are borrowing in this interbank money market. Okay, the banks are borrowing in this interbank money market. That is, if a particular bank is not fulfilling its criteria of SLR, then it will contact some other bank which is having excess quantity in its SLR, and that bank which is having excess quantity in SLR will lend to that bank which is having low quality in SLR. So this bank is taking loan in order to fulfill its gap in the SLR quota, and another bank is lending its excess amount in order to get some interest on it. And not only banks are involved in it, what is happening that there are many funds, large corporations, large companies, mutual funds are there, other large insurance companies are there. Now they also work on a big scale. Now obviously these mutual funds, large corporations and insurance corporations, they don't need to maintain CRR and SLR, but still these big corporations need money for their daily functioning, and many times such event happens that they need money instantly. They need money in hurry. So when these big institutions need money in hurry, then they go to this interbank rates and borrow on this interbank rate. This is known as federal fund rates in the USA. In London, it is known as LIBOR. This is LIBOR is the acronym of London Interbank Offer Rate. It is the global reference used for unsecured short-term borrowing in interbank market. So it is a benchmark for short-term interest rates. So this, differs from country to country. In India, what is this is known as MIBOR. MIBOR in India refers to Mumbai Interbank Offer Rate. It is a standard reference of interest in call notice money markets in India. Got it, friends? So basically on the basis of this Mumbai Interbank Offer Rate, banks in India are lending and borrowing in interbank manner. And basically this MIBOR is calculated by National Stock Exchange after taking quotes from a specific set of banks. Also the short-term fund market are found in commercial centers like Mumbai, Delhi, Chennai and Kolkata. So this interbank borrowing is going on in the economy. Now, when this interbank borrowing is there, obviously the rates in interbank borrowing is very low. I have already told you that in money markets, the rate of return is very less. The rate of return is very less. Why? Because those banks which are parking their excesses, which are lending their excesses, they are lending it for a very short amount of time. And the other bank or the large corporation is taking money for a very short amount of time, and then he is going to repay it. So obviously the rate of return is less. Now in this case, one question will come to our mind that can retail customers, can individual customers get loan at these rate of interest? You can see that in money markets, the money is available at a very small amount of interest rate. So can individual consumers and retail consumers can get loan at this much small rate in the money market? No. Individual customers don't have this much financial genuinity. They don't have this much financial credibility. Large corporations, insurance companies, mutual funds, they are very credible. So they can borrow in the overnight market at a very small rate. But retail and individual customers cannot do it. Got it, friends? So this interbank borrowing is going on. And this interbank borrowing works on an international basis, friends. Many times what happens that back internationally, for example, the State Bank of India can directly contact Citibank in USA for this interbank borrowing. They both will decide on a definite set of overnight borrowing rate and they will borrow. So basically this SBI and Citibank in USA, they can also involve themselves in interbank borrowing at a decided set of exchange rate. So basically this interbank borrowing is not only in the banks which are in a particular country, they can be in between banks which are in different countries. Got it, friends? Now, you should be very much clear that what is basically this call money. Call money is something, friends, when this money, the short-term borrowing is taken for 1 day. Then when the money is taken for 1 day in this interbank borrowing, then it becomes call money. When the time periods exceeds 1 day but is less than 14 days or 15 days, then it becomes notice money. And when the time period exceeds 15 days or 14 days, then it becomes term money. So basically this is call money, notice money, term money. The definition of call money, notice money and term money can only be understood if we are able to understand interbank borrowing. And interbank borrowing is going on globally, friends. It is a global practice. It can happen between banks of the same country. It can happen between one bank and one insurance company of one country, or it can take place on an international level. So not only banks are involved in order to meet their reserve requirements, but also other corporations like mutual funds, insurance, they are also involved in order to get money, in order to gather money for meeting their day-to-day requirements for functioning. So I hope this video was making sense to you. Thank you for watching, friends. Hindi version is already uploaded. Please follow me on Instagram and subscribe on YouTube.